All right, so let's go. That's all cash purchase. Now let's look at what happens with a 25% down payment. Same purchase price, OBS, less down payment, $68,600 because you're only having to come down with 25% plus closing costs. Net rental income in year one now is slightly negative, $1,200 at the end of the year. Net rental income year 10 is positive, $577. Home price appreciation in years 1 through 10 is now 96,597, and your total profits years 1 through 10 is 116,000, but the IRR shoots up from 8.4% to 9.9%, almost 10%. GC, what's happening here?
This is the number one reason why the wealthy would choose to use debt while purchasing a property, because wealthy folks, and we all, should aspire to make decisions based on our return on investment. And when you are able to use a 25% down payment, that means you're using somebody else's 75%. You're using the bank's money, you're using other people's money. And what you're able to do is to control and own an asset, but only put a fraction of your own money into the deal. And the way to calculate your return on investment is not how much money did I earn over the purchase price. It's what is my return on my investment. Mm-hmm. And so that's why you're able to take an asset that is worth $240,000, own it, control it, get all the benefits from it, but you only had to put $68,600 into it. And through those profit centers, you're able to grow it to the tune of over $116,000 over 10 years. And so that delta from $68,600 to $116,000 is a better return than the all cash purchase, which may have beefier numbers, but required a much more capital intensive approach to get into it.
Got it. Anything to add to that, Paul?
Yeah, I think this is someplace we should pause and sit in, and people should really think about, because some things jump out to me, right? And I've said it every show, and I'll continue to say it every show. Understanding your unique investment objectives, what you are trying to do, is key to this whole thing. What we're trying to do is provide the financial education, like I said earlier, to give those tools in your tool belt. You pull those tools out to achieve results you want. The tool of leverage here, what we're showing is what does that provide? Well, it provides you exactly what Greg said. Your nest egg isn't in one basket now. Your nest egg is spread out through a lot of different baskets, right? So that provides a little bit of, in my opinion, lower risk, right? You can put $60,000, $70,000 down on a bunch of different properties and have a lot of engines that provide you cash flow and returns, right? Rather than one engine. I like that concept. Many people like that concept. What else does it do? Well, it accelerates our growth and our returns. My dollars are working harder for me in that engine, in that chess piece that's on the board. And when I have multiple different ones of those versus one, I have more chances to win, right? Let's just break this down really simple. So that's one of the reasons why the wealthy do this, right? Get as many chess pieces on the board as they can. That's what Greg talked about, of controlling the asset for as low down payment as you can. What does that do? It gives you more chances to win, right? And what do the wealthy do? They win a lot. You may lose sometimes, yes, but if I have more different chess pieces across the board, everything has risk, but if I can spread my risk out, absolutely a win, right? Absolutely one of the tools the wealthy use. The other thing here that's important to understand is what we need to understand is what's a lot of the wealthy's investment objective. Again, we hit this on the last show and it brings up again. The objective isn't necessarily short-term profits. The objective isn't necessarily short-term cash flow, right? Because what the market is providing us right now with the interest rates the way they are, the prices the way they are, just in the economy as a total with inflation, cash flow is being a little bit squeezed compared to where it was 5 years ago, 10 years ago, 15 years ago, right? So if our objective doesn't shift along with what the economy is, we're going to miss the boat a little bit. You're going to not have the full education to make decisions that's best for you right now in the economy we're in. We all can lament, oh, I wish it was 2008 again where I could buy everything at a crazy discount. We're not there. It's not where we are, right? The economy is where it is. What's the best decision we can make right now for us to help us get on the path to where we want to go? So if the objective is you can wait 5 years, 10 years, and you don't need the cash flow coming in from this, which is a lot of the wealthy situation, the returns are absolutely better overall when you use leverage, right? So it's understanding and starting to apply, well, why would I do this? Well, it accelerates my overall returns. It allows me to spread out my risk. It allows me to have more chances to win, right? A lot of these things you're starting to understand, oh, okay, I get it. 25% down, I may get maybe a little bit lower short-term return, but my long-term return is absolutely where I want to be, right? And we haven't even got into principal pay down and compounding and all that stuff with Greg. I'll let you get into that.
Well, if you're going to give me that softball, I love talking about the 5 profit centers. Should we go into the 5 profit centers?
By all means.
All right. Well, there's 5 ways that are contributing here to result in that total profits thing. And if there's one thing I've heard consistently through speaking with literally tens of thousands of investors over the last 18 years is that they really focus on cash flow when they're at least evaluating a property right off the bat. It's the most common thing. But what is lacking from an education piece is if you actually own real estate and you hold on to it for a full market cycle and you look at the end, like I own real estate now for over 18 years now. And I look back at those purchases that I made 18 years ago and I say, how did I get these profits? And was it cash flow? Was it the other profit centers, which we'll go into? It was not cash flow. It was the other profit centers. And actually the biggest driver of your total profits when you actually own real estate for a full market cycle is home price appreciation, which most investors say, oh, I don't want to count on that. I don't want to think about that. I can't count on that. So there's a missing education piece on 2 levels. One, cash flow is not the biggest driver of your returns over a full market cycle. And number 2, that you can count on home price appreciation given a long enough runway. And so when you combine both of those education pieces, your perspective starts to switch. The way you make decisions starts to switch because it's more in line with what's actually going to produce a better outcome for you over the long haul. So with all that being said, there's 5 ways that you get paid when you own a rental property. There's cash flow, which we just talked about, right? It is important. It's like the entrance to the dance for many people, right? We want to have an asset that pays for itself every single month, and that's what we can create for you. But there's an overimportance on cash flow that many newer investors cling to. And so we need to be more open-minded than that. Next, there's tax savings. So you get incredible tax advantages by simply investing in this asset class. It's available to everybody who invests in this asset class. You don't have to have a certain criteria. You don't have to have a certain job. But what this does is defer the taxes that you need to pay on the income that you earn, which is amazing. We love that. Then there's principal pay down. There's this concept that when you take this loan out, it's not you who's paying the loan back. It is your tenant or resident. We call them residents, right? It's your tenant or resident who's paying that monthly mortgage payment for you. They pay it to you in the form of rent, but in essence, that pays your loan back for you. So that's the principal pay down component. And guys, that adds up. After 10 years or 18 years or longer than that, you take a look at your loan balance and it didn't come out of your pocket, but hundreds of thousands of dollars of value created there. So a huge and misunderstood profit center there. Then we have home price appreciation, which we can talk a little bit more about if we'd like. But at the end of the day, it's the biggest driver to your returns. It's the biggest piece of the pie. So we need to focus on that for sure.
Yeah, totally. I do want to talk about home price appreciation, right? Like what Greg is talking about, the biggest piece of the pie. And we've done a bunch of these. So we have these different segments on the show. One is this, we do like a rabbit of the week. We do like a portfolio of the week. And then we also do a guest investor of the week. And we bring on past investors that have been investing with JWB. And we always break down the returns based on the different profit centers. And we make it a pie, right? We make it a pie chart. And what you always end up seeing is it looks like a Pac-Man, right? Like it's like a Pac-Man. And every other profit center is the mouth of the Pac-Man. And home price appreciation is the Pac-Man itself. Some people it's like 90%, other people it's like 60%, right? But it's always clearly like either a Pac-Man with its mouth wide open or slightly open. Mm-hmm. And that's kind of like when we talk about piece of the pie, home price appreciation. Speaking of home price appreciation, there is a couple people that have asked in the chat, Why is the home price appreciation in the all cash different than the home price appreciation in the down payment?
Our community is so savvy, and I'm so glad that you guys asked that question. The difference is the closing costs. So when I prepare this, I try to condense some things to save some space. So I put the amount of closing costs and factor that into what your net home price appreciation is. And these would be closing costs on the buy side or the sell side. And so on a cash purchase, there's less closing costs. And then on a 25% down payment purchase, there's more closing costs to the tune of about $12,000 more. So that's the difference there. Your home is actually appreciating the same, whether it's a cash purchase or if you use financing, but I'm taking into account the loss from incurring the additional closing costs, and that's what's factored in there.